Okay, so let's analyze these transactions listed here. Remember, in accounting, a transaction is any event that has a direct effect on the accounting equation. So liabilities will be increased or decreased, assets will be increased or decreased, equity will be increased or decreased. It really needs to result in something. You must have to have a receipt. So if the economy around a business is collapsing, well, the financial position of that business is definitely affected, but accountants won't recognize this. It's only going to be something that's affecting that accounting equation, something usually with a receipt, something involving a receipt. So, okay, let's once again let's rewrite the accounting equation and explain explain the equation. I'm going to do this over and over and over again because it's extremely important that you understand exactly on a deep, deep level what this equation represents. Okay. So assets equals liabilities. So the total value of all of your assets is equal to liability plus equity. Okay, so assets. I like to think of assets as these are the tangible physical things that you can visualize and wrap your head around about a business. Okay, so if you go drive by any business anywhere in the world, all the total value of all of its assets is just everything of value that it is currently in possession of, that it's using to run that business. So like the building, the land, all of the equipment, furniture, office supplies, inventory. It's kind of the cash it has in the bank. Anything, it's anything. It's physical, tangible things like you can tell, but also it has to be associated with running that business. So the owners might have their own personal bank accounts that they use to buy things for their house and go fishing or whatnot. That asset is not associated with running the business. Okay, that's your left side of the equation. The right side is just telling you who states claim to those assets. So like liabilities and equity, while assets are more tangible and physical things you can wrap your head around, liabilities and equity I look at, these are more of kind of intangible, non-physical, theoretical ideas that just tell you where these assets came from. So if you were to sell off all of you got a business closes down, sells off all of its assets, now it has this big pile of money. The first thing that the owners are going to do with that money is pay off all of their creditors. That's the liabilities. The rest of the money they're just going to divide amongst themselves and just put that in their own bank accounts to maybe open another business or something. That's the owner's equity. Okay, owner's equity. Remember, you can kind of separate that into two categories. One category is called common stock, which is just however much money owners have taken from personal bank accounts or from friends and put into the business. Okay, that's common stock. The second category of equity is retained earnings, which is just as the business was running, it generated cash or revenue from, it created equity. And so that's the owners. They stake claim to that value, that asset, that cash asset or whatever. Okay. So let's analyze each transaction one by one now. So on May 1st, we received $4,200 cash and issued common stock. So okay, we got cash into our business. This is a physical asset, cash. So our cash account in the assets section went up by $4,200. So where did this cash come from? Did we borrow it from the bank? No. Did we run the business and generate revenue? Did we earn $4,200 profit? No. Some external investor gave us money, gave us an asset in exchange for shares in the business. So the common stock increased. This cash came from common stock. So the common stock account increased by $4,200. Okay, so as of May 1st, does our accounting equation balance for this business? Well, yes, it does. 4,200 is equal to 4,200. So yeah, remember, you leave your house right now, drive anywhere in the world, any business, anywhere, that business's accounting equation is going to balance, or it should balance. If it doesn't balance, then it doesn't make any sense, right? Because remember what this equation is saying: all the assets of that business are accounted for by they came from either creditors or the owners themselves. I mean, that has to be the case, or it's just a law of accounting, of nature almost. You can't have assets came from liabilities plus equity plus what? Plus a ghost. This equation, it just summarizes the standing of a business, right? Okay. On May 3rd, purchased a mower on account, $2,100. Okay, on account. On account is just a promise to pay money later. So as a business, we're either going to pay, it's a promise to pay a creditor later, or a customer is promising to pay us later. So since we received an asset, that means we had to pay for this asset, and that must mean we are promising to pay a liability on account, $2,100. If you're paying a liability on account, that's going to be an account payable, right? So, okay, we got a physical asset into our business. So this is in our assets section under the equipment account. The equipment account will increase by $2,100. Okay. And where did this asset come from? Did we generate revenue and buy our equipment? No. Did someone outside the company say, hey, here's a lawnmower, I'll give you that if you give me some stock? No. We borrowed the money. We purchased the lawnmower on account and promised to pay for it later. So under the liabilities section, we have the accounts payable account increased by $2,100. Okay, once again, does the equation balance as of May 3rd? Well, yes, it does. All we did was just add 2,100 to each side of the equation, okay? May 5th, performed lawn services for client on account, $700. So once again, on account, a promise to pay later. Well, we performed some services, so this must mean that there's a promise that a customer will pay us later for our services. So if we're going to be paid on account later, this must be not an accounts payable, but an accounts receivable. Okay, an accounts receivable is an asset because it's money that we're owed. Okay, it's not quite cash, but it's close to cash. Accounts receivable. This asset increases by $700. Okay, now where did this asset come from? Did we borrow it? No. Did someone give it to us in exterior, someone external to the company give it to us in exchange for ownership shares in the company? No. We performed our service. We ran our business. It's associated with running the business. So this is in that retained earnings section of equity. Retained earnings you have revenue, expenses, and dividends. This is under the revenue category. So performed lawn services, service revenue. This $700 of accounts receivable came from our service revenue. So in equity, in the retained earnings section, retained earnings section under the service revenue account. Service revenue, this increased by $700. Okay. So once again, does the equation balance? Well, yes, it does. We increased each side by $700. Okay, on May 17th, we paid $140 cash for gas used in the mower. All right, so $140 cash left the business. So this is a good time to point this out. Whenever you are analyzing transactions, or you're acting as an accountant, and you're trying to see, hey, is the number I'm going to put going to be negative or positive? Dividends are going to be negative. Cash, when is the numbers I'm putting in negative or positive? You always want to look at this equation like you are the business. Okay, you are in this black box. You're the business. If you have money coming into your box, into your business, or if you have equipment coming in, value coming in, then that's going to be positive because it's coming. Imagine that as coming into your accounting equation. If money is leaving, if equipment is leaving, so you're paying off dividends to yourself, that's money leaving. Okay, that's going to be negative because it's also leaving the accounting equation. Okay, so we paid $140 cash, so $140 left the business. Okay, let's calculate this here. Okay, 4,200 minus 140. All right, our cash account, the new balance for the cash account is $4,060. So this $140 cash that left, how do we account for that? Where did that come from? Why did that happen? Okay, we didn't pay off a liability. What we did was, this is associated with that retained earnings. Okay, this is an expense. So we're going to have all of our service revenue, and we're going to subtract out our expenses. So our expense account increased. So I guess I'm just going to put, I'm not going to put gas expense here. I'm just going to put the expense, one of our, oh Lord. Okay. Our expense account went up by $140. So it's going to be a negative 140, right? The reason being is because equity leaves. So this gets confusing. It's easy to visualize. Oh, of course, $140 cash left the business. Subtract out 140. But remember, equity and liabilities, these are kind of those theoretical, intangible aspects of the accounting equation. So it can be a little trickier here. But equity decreased. You lost $140 cash, so your owner's equity also decreased due to an expense. Okay. Once again, does the equation balance? Yes, it does. We subtracted $140 from each side of the equation. May 28th, paid cash dividends of $800. Okay, so cash left the business. How much cash? $800 worth. 4060 minus 800. So now our cash account balance is $3,260. Okay, so how do we account for that? Where did this decrease in cash come from? Well, it had nothing to do with expenses, nothing to do with liabilities. We paid ourselves $800. We took out money from the business to pay ourselves so we could go fishing or something. Okay. So where is this? What part of the accounting equation is paying ourselves associated with? That's retained earnings. Retained earnings, net income, less how much you decided to pay yourself during that period. So this is going to be under retained earnings. In the retained earnings section, you're going to have a dividends account. And when this account increases, your equity is decreasing because you're taking money out. So this is going to be a negative 800. Okay. So once again, does the equation balance? Yes, it does. We just subtracted 800 from both sides. So as verification for the month of May, to make sure our equation still balances, let's add up each side. So 3,260 plus 700 plus 2,100 is $6,060. Here's my pen. $6,060. Okay, now 2,100 plus 4,200 minus 800 plus 700 minus 140 is $6,060.